Welcome back to the channel. I'm Foreman, and in this video I'm going to be telling you the UK stocks I'm buying right now, as well as the week's worth of updates. And in particular, I'm going to be talking about a few companies such as JD Sports, Darktrace, Boohoo, Games Workshop, Team 17, Frontier Developments, and also Dunelm Group. So if you're interested in that, please drop one of these to help beat, that was a terrible one of these to help beat that YouTube algorithm, as it is much appreciated. It's also a cheeky way of me actually doing a sound check so I can sync up my audio tracks for those that do like their editing. Now, my portfolio has been battered. The FTSE 100 is up by 1.31%, the FTSE 250 is down by 1.12%, and the S&P 500 and the Nasdaq haven't closed as of recording this video, but are down about 0.5%. My portfolio itself is down by 7.51%. Yet again, I have little to no concerns about this. In fact, some of you watching this video seem to be a lot more concerned than I am. But I've done the research, I've done the work, I understand my holdings, and so I have no real reason to be worried. Yes, I've now reached a point that I am down 5 figures. Yes, this is a significant sum for some people, and it is actually a significant sum for me because a majority of my net worth is in this portfolio, and so yes, it is a significant amount to me. However, I know that I do not need to touch this money for many years, and so the volatility at the moment is of no consequence to me. The companies I'm invested in are growing. Well, we'll talk more about Games Workshop later on, but these companies will continue to grow in my vision in the longer term future, and are going to be companies that are still going to be around, and so I have little to no reason to be concerned about the day-to-day movements of the share price. It simply doesn't bother me. Instead, I'm scaling in and buying the dip. Now, the first item of news is Dunelm Group. They've had their second quarter trading update, and they've mentioned that in the quarter 2 of 2022, was it, or which financial year is this? I believe this is financial year 21 for them. They've seen a year-over-year increase of their total sales of 13%, and they've actually seen a decline in their digital sales by 8 percentage points, which is quite interesting to see. But overall, for the half, their total sales is up 11%. I think this is quite impressive for this company, and I think there's a lot more growth potential in the future for them. Worst comes worst, they are consistently making money. In fact, I really like Dunelm Group. This may become an addition into my growth portfolio once I've likely gotten enough or a big enough holding in Boohoo and Games Workshop, where I there feel comfortable opening a third position. Dunelm Group at the moment is actually the likely contender. Yes, it has lower growth potential than both of the companies I've mentioned before, but they are generating lots of cash, they're well managed, and they are growing year over year. This is one of those consistent performers that you know will grow in the future, and this is a company that will likely be around in the next 50 years. Who knows what quality they may be around, but I do very much like the company. Interesting to note, I believe it said that they had 176 stores, I believe. I can't actually see it at the moment because there's so much information on my screen. Yes, 176 stores. They have superstores, really. It's kind of quite like Costco, where they convert a warehouse and they have these large stores that customers can go through. So I'm not sure on perhaps the total capacity of the UK and how many stores they can effectively open, but considering that they are diversified into the UK, there's definitely growth potential in the future should they want to expand out. And they've actually seen their gross margins in the second quarter increase by 160 basis points, and this is actually because in the first quarter they had seen a decline in 10 basis points, so now they're doing quite well with an increased gross margin of 80 basis points for the first half. Again, confident on this company. I've not bought more. I think they're a little bit pricey. I don't think they're bad value per se, but I think they're quite pricey when we can see all of these beaten up growth stocks in the markets, and I think at the moment they're more in favour, or at least the markets see them as in favour, and so I'm less interested. No doubt when we do see the indices fall, or we may see a correction or a crash or whatever in the general markets, then I'll be interested to top up on this stock, but that would be assuming at that point the growth stocks have already been battered enough, and who knows, because they may fall further. I am no oracle or sage. The next topic to talk about is, actually, I'm jumping ahead of myself. Dunhill Group, I do like in particular, is their return on capital employed. This is fantastic, and this is how much money they're able to invest back into the business and what kind of a return they'll get. Seeing that they can get 31.4% return on their capital employed is very strong indeed, and they've got good figures all round, including their financial health, which in my opinion is fantastic. The next item of news is Darktrace. Now, Darktrace is an industry that is well out of my circle of confidence or understanding, but I would like to cover them anyway because they are seen as a high growth stock. Now, in the first year of their the full financial year, I'm just going to say that now instead of trying to guess the year that they're actually in, they've seen a year-over-year growth of 39.6% in the number of customers. They've seen at least 45% in constant currency ARR, and they've seen at least 50% year-over-year growth in revenue. Now, I like Darktrace. I think there is growth there, and I do think cybersecurity is something that we're going to see more prominent in the longer term future. But the management of Darktrace is what does concern me. They may have a few well-named individuals, but when they listed earlier in the year and then decided to use the funds that they had raised from the listing to then buy back shares seemed a bit ridiculous to me. After all, if you didn't need that money, why list in the first place? Why not stay public? It looked like they were trying to take advantage of the idea that they were very much in the hype at the time and then tried to take that to buy more in. I'm not really sure what they were trying to attempt here, but again, that's up to them. Share buybacks at best can be questionable. A lot of the times these buybacks are done when the share prices are at highs and not when they give the most value to shareholders. Regardless, they've had a very strong trading update, and if they continue to grow, which I don't know how because I don't understand it, but it could likely be a good winner for the longer term, providing that they are bought at a fair valuation. JD Sports Fashion PLC has announced that their 22-week period, which is an interesting time period that they have got for January 2020, is that they've had like-for-like growth of their businesses that is 10% ahead of the same period in 2020. This, I think, is quite misleading because a lot of the stores were shut in 2020, and so it may be a lot worse than it looks. And because it's very much text heavy, you can be easily misled by this, because if you go, yeah, 10% ahead, great, they're growing, this is promising. But in reality, in 2020, what if they had declined by 30% and now they've only seen a 10% growth from that bottom point? Again, misleading. You would then have to read multiple statements from the company to really get a clearer picture. It's like accountancy being a dark art. You really need to dive into the financial statements and see how their operating profits are to really understand and how they can be potentially manipulated in order to make the business sound better than it is. I do not in any way understand accountancy yet. I'm diving into it. It's a definite weakness in my strategy, and I'm trying to understand it more, but I'm still nowhere near competent to talk about the individual financial statements. Regardless, we have seen that actually they're materially ahead of expectations, because they believe their profit before tax for the full year will be £875 million, which is ahead of the market expectations of £810 million. Now, this is promising, and this is promising for one of my holdings, Boohoo, because if we're seeing retail and growing and seeing a lot of demand is the key thing here. If this company is seeing an improved amount of demand, it means that Boohoo will likely represent a similar trend and benefit from that too. But then JD Sports is also very much a retail store based company, and so this could mean actually consumers are favouring the idea of going into a shop and purchasing products instead of going online and ordering them. So again, this could also be a negative for some of the online retailers, and it would be perhaps fascinating to see how this plays out in the next few years. Regardless, competition is always good. To see that this company is actually recovering, or at least growing upon their revenue from the last year, is very much a promising sign indeed. Which brings me on to Boohoo. Now, they've had a dilution, well, somewhat, and this is of 5.21% of the issued ordinary share capital of the company, meaning that shareholders in Boohoo already are going to be diluted by 5%. Usually this is done to raise capital. However, in this situation, this technically isn't a dilution because this is a share incentive plan. The idea here is that each of their employees, if they sign up to this, will then be redeeming free shares each year that they are in the company. Now, they've only had a total of 4,924 employees, and they're awarded approximately £3,600, which I believe, according to law in the UK, is the most that a company can give away for free without being taxed. It's an advantage for the company because I believe it counts as an expense, or it's a tax write-off or something like that. positive sign. It's also great for shareholders because it means employees make up a larger portion of the share pool, and is a great sign there because at least then it means they have some more significant skin in the game. Always a positive sign, especially if these employees are then like, okay, well, I can't access these shares in the share incentive plan for 3 years, otherwise they're forfeitable. So therefore, I've got to stay with the company for 3 years. But then the next year, they get awarded even more free shares, and then it pushes them on. It encourages employees of the company to stay along. And don't get me wrong, Boohoo is not unique in doing free share awards. Many listed companies do this. I'm very much aware of that. But if for someone that doesn't realize the importance of this, I feel it's important to clarify. In particular, we can see that obviously it's 5.21% of the overall share pool, which is devastating, truthfully. However, the reason why this is so devastating as it is because Boohoo shares are at a significant low. And in fact, if I was an employee of the company, I'd be very satisfied getting that many shares at that amount, because it's very likely that in 3 years' time, their £3,600 is going to be a lot more. And that is promising indeed. And then what we'll see is, as actually the market capitalization starts to build up over time, presuming that the company is able to grow upon their financials again, that actually employees in this share incentive plan are going to get much less percentage of the issued ordinary share capital, meaning that there's going to be less of a dilution factor. One more point that I would like to bring up is that this is forfeitable, meaning that they're not immediately eligible for this. They need to wait 3 years. Now, if I'm right, and I believe this depends on the company, but at least from my experiences working in a public company, in our case, we would have free share awards. After 3 years, you can sell them, but they will be taxed. After 5 years, you can sell them tax-free. I'm not sure if this is the same for Boohoo or if this is a general pattern for share incentive plans, but that might be something to factor in. Regardless, this is a positive sign overall for the company, but it is obviously quite a negative short-term sign for shareholders, as they have obviously been diluted. But if an employee leaves the company within the next 3 years, then they forfeit that free share award, and the company's share pool is not going to be diluted by as significant of an amount. But it would be a more promising sign if actually a majority of these employees do not forfeit this amount, because it might show that actually Boohoo has a very good stability amongst loyal employees, meaning that people that are in the role or people that are in the company are more likely to stay in the company. A lot of people talk about employee turnover. Turnover is a good metric, but stability I prefer, because this shows, okay, how much of the employees here are staying. You could have 19 employees at Boohoo out of 20, but then that one last slot, there's people joining and leaving after a week. That would suggest that they have a very high turnover if there's people joining and leaving every week for a year. But if you look at stability, in fact 95% stable, meaning that the 19 employees stayed there for the entire year. So overall, it's a positive. And I have been buying more shares of Boohoo. I now hold 9,993. I know it's absolutely so close to 10,000, it's quite ridiculous, but I wasn't just going to buy more for the sake of rounding it up. In a way, though, I was quite tempted to get 9,999, just because it would really drag on and it would just never hit that 10,000 figure. Regardless, I've bought 442 more shares of Boohoo this week. My average share price has actually dropped, and according to my spreadsheet, a week ago, I believe my average share price for Boohoo was around about £1.8990, and now it's about £1.8550. Obviously, I don't like how there's 4 decimal places, but I'm afraid it will have to do. I suppose I could shrink it down. Typically, the average price on the spreadsheet for Boohoo is off by about 0.2 pence. So it's a very small margin of error, but it really isn't bad at all. And I think this relates to the 16 shares I sold at some point to, I don't know why I sold them. I'm pretty sure I sold it to make my figure more round. But again, it was vanity purpose and not really any investment strategy purpose. But I suppose if I sold those shares at roughly £2.55 each, that I've technically only realised a gain on Boohoo. That's something to think about. We've also had Asos's trading update. Now, Asos is, in my opinion, is one to follow if you're a holder of Boohoo. I think that's the case. And I nearly said particularly interesting, which is words I keep saying all the time, and it's really driving me mad. I'm trying to really flex about or rotate my my idiolect, my working vocabulary, so I don't repeat too much of the same word. They've seen revenue growth of 5% at a constant currency basis in the first period of the year. I believe the period relates to a quarter, which would make sense. I'm hopeful that's what it means, otherwise I'm being totally misled. Yeah, well, they've got 4 months to the 31st of December. They've stated that actually, I think this is just a period. This is just 1 month. Anyway, they've stated that in the 4 months to the 31st of December, they've seen an increase at a constant currency basis of UK total sales by 13%. That is quite a low figure. Don't get me wrong, that is an impressive figure. It's good for a company. But when you compare it to Boohoo's total sale growth in the UK, it was 32%. So there's a lot more growth potential with Boohoo here. However, it must be noted that actually in the EU and the US, the Asos performed more favorably than Boohoo did. They'd seen a lower decline overall at different, not taking into account currency basis, although the rest of the world I think very much is a similar basis than Boohoo had. It is something that I find useful to look at because Asos, whilst yes they are different business models where Asos is primarily a marketplace for retailing other branded goods, they are both online e-commerce businesses that sell clothing to consumers, so it will be something worth of mention. They also announced that their intended move to the London Stock Exchange main market from AIM. Now this would be seen as promising for shareholders because there's tighter regulations on the main market, and it may also mean that they become a respected business in the FTSE 250 with time. At their current market capitalization, I believe they would be eligible, but I believe there are some further steps to be made, but overall a promising sign because a lot of funds do not invest in AIM listed equities. There are some people going to be, well, if Asos has done it, aren't Boohoo going to do it too? I'm not bothered, and I don't think they will either. Boohoo have a high amount of individual insiders because their company is primarily a family-run business. The advantage of the AIM listing is the inheritance tax exemptions, meaning that if they join the main market, yes, they may see a flux of more investors, but over time they're going to lose more control in the business, which I don't think is something they want. They're going to want a remaining controlling interest in the business so that they can therefore align themselves with the growth of the company. They're not going to want to move over to the main market. Good move for Asos because they have very limited individual insiders. Poor move for Boohoo in my opinion. We've also got Games Workshop PLC's trading update. I've spoken a lot about this in a video earlier in the week, which was bad earnings. Should you sell? Card at the top right of the video. Now, in particular, I'm interested in this one point, and this is that their operating profit pre-royalties receivable has declined from a year-over-year basis. This means that they are selling less miniature figures, and actually that overall, because their operating profit at constant currency has increased, it means that actually their royalties or the licensing of their IP to other businesses has increased. So overall, it's a very much a mixed bag. Is it a good thing? Is it a bad thing? Well, they're selling less of their figurines and products. That's a bad thing. But they're seeing more interest in businesses into their intellectual property, which is a good thing. This suggests that their universe has value and more companies are interested in using it. So overall, it's a very mixed bag. And at the moment, we're seeing a reduced volume for Games Workshop's miniature figures, and that is a concern. If they cannot increase this volume once more, they may be priced as X growth, which is where I think shares will start to decline over time. Shares have declined by a significant amount in the last week, about 12%, I believe. This does not mean I'm buying the dip. I'm not interested in buying the dip at the moment. This is purely something I'm going to continue to hold for now. I will likely buy the dip if it declines further to a more attractive valuation because the quality of the management is top notch. But at the moment, as I said before, Boohoo has declined by much further amount, is at a much attractive valuation and has potentially much more growth potential in the future in terms of their retailing, and so I'm more interested in Boohoo, which gives me quite an interesting split between it. Games Workshop has also announced a dividend of 65 pence per share, which is a massive chunk, which totals 165 pence so far in this financial year, and I believe 76 times 65, as if on the top of my head I'm going to get that, I believe is something like £56 or something like that. I have no idea if I'm close at all. Now, if you're interested in signing up to my Patreon, I have got a link in the description down below. This is where I give you complete access to my holdings, but if you'd like to find out more about that, click the link in the description down below. Frontier Developments has also had their trading update this week. They've seen their half one revenue up by 33%, and in their words, well positioned for an exciting 2022. They've seen their revenue increase by, as I say, 33%, but their operating profit has gone into negative territory, going from a 19% operating margin to now a 3% operating margin. However, I believe this is due to the fact that they had amortized their Elite Dangerous new update. I forgot the name of it. Was it Horizons or something like that? And they had done this for a 6-month period due to quite a poor release. And they'd also written off a month of their Jurassic World Evolution 2 because I believe that also had a poor month of sales, suggesting that actually a majority of their operating, let's have a look, if I go to operating loss, would be from research and development expenses, which for the most part will be written off parts of their amortization, which if I find that now, amortization, let's have a look, go down a bit more here, R&D or amortization charges are something like £12.2 million, and this is because of their major expansion for Elite Dangerous Odyssey and 1 month for Jurassic World Evolution 2, as I was saying. So actually, I don't know if it is as bad as it seems. It means they've had a poor launch, but at least in the future they have got some exciting things coming through, and I believe they were setting up for an annual Formula 1 management game, and Formula 1 seems very, very popular at the moment, so I have a feeling this will be quite successful. Perhaps not worthwhile investing at the moment, but they do still have a strong cash position, and they are obviously very liquid, so they do seem quite promising. Which brings me on to Team 17. This is a former holding of mine, and they've announced a €100 million acquisition of Astragon. Now, this is absolutely flipping ridiculous. This is a huge acquisition for something that, well, we'll have a look at in a second. It makes sense, but for considering their cash position is not even a third of that after their most recent acquisitions, I think they're getting a bit too greedy and they're doing way too much of this, and they've had to dilute shareholders to achieve this purpose. They need to raise the capital, and I believe it was at £80 million, by diluting their shares by about 8%. That is a significant amount, and yes, this is a brand that means they are more diversified in their offering, and yes, it does mean they can offer complementary simulation game categories, or but what I don't understand is why could they not be patient on this? It seems like they're getting the fear of missing out and buying all of these things. It's like me going, oh, I'll go blockchain, yes, I want to buy that. Oh, I also like Dunhill Group, I want to buy that. Oh, I also like Boohoo, and I'm just literally just run out of money by doing that. It seems, in my opinion, a poor management execution. And you look at the catalogue of Astragon, right? Bus Simulator 2021. My camera keeps overheating, so I'm going to try and make this quick. Bus Simulator 2021, an interesting choice of something to acquire. Police simulator, firefighting simulator, construction simulator, for instance. Now, you can look at this and immediately judge it, and for the same reason I am too. However, I do know that these games are very, very popular. The fact that these type of games are popular is quite sad to me, in fact, but I can see the use case for this. Perhaps in this situation, someone may no longer be able to drive a bus, for instance, but they would very much like to do so, and so having this available is a good idea. But perhaps I'm looking at these games from the wrong angle. Perhaps I'm not seeing it for perhaps recreational purposes where they can get an enjoyment out of playing it. Perhaps it's genuinely for the training. Perhaps it's for getting themselves used to this. Perhaps this is something that can mean actually you can be a member of police, really go for it, but not have to risk yourself in real life. So these businesses, these games in particular, do quite well, and so it's not a bad acquisition by any means, but to pay €100 million for this, I think, is ridiculous. When they have to dilute shareholders in order to pay for this, where they've had to place 11 million shares to the pool, and I believe they now have 144 million shares in total, close to 145 million shares. I think this is a very bad view. I think the management isn't looking at the shareholders. I think they're looking just at the business itself. They're looking to hit certain quota, and I'm very much not a fan of this. I'm actually quite happy that I sold out of this share. Yes, Team 17 have a well-diversified catalogue of good games. They do have some promising games that they have, and there are some of them that are very popular. But when they make reckless moves like this, where they have to raise capital in order to grow, I do not like this. For very similar reasons, I moved away from Argo Blockchain, because Argo Blockchain were being quite ridiculous, in my opinion, in order to dilute shareholders, to then grow the business, to then also raise debt, and then also to not sell their their hodl that they could have used to raise more cash or to gain more debt. It was a very aggressive strategy, and I'm not a fan of that. I want to invest in a business that I know the quality of them is good. I want to know that the fundamentals beneath it are strong. I want to know that they have little to no debt, and I want to know that they have cash available. This is why I like Boohoo. Boohoo acquired Debenhams, Burton, Dorothy Perkins, and Wallace through the cash on their balance sheet, not through raising capital. In this case, not a fan, and I'm sure I'm being very, very biased against Team 17 here, and perhaps the revenue of these games is worthwhile for this, but full stop, I'm just not. I would need to look into this further, and I haven't, so that's where things change, but not a fan whatsoever. And this brings me on to a holding I've bought in my SIP, which is actually Redrow. I've bought Redrow again, and I believe this is because the fears in the market are currently a little bit overstated. This was due to the fact the UK going on about that they're going to make house builders pay for the cladding issues, I believe, and so a lot of these companies have set aside provisions for this. But when you look at a company like Redrow, their financial health is strong. They have no debt and they have cash on the balance sheet, £160 million of it, and so they will be well weathered to deal with the storm. For instance, their past performance has been a bit shaky, but it's on a good trend upwards. Again, I'm not investing on as much detail as I do with my growth portfolio in the stocks I do in my SIP, but I think they are at a good price to book ratio. I think that they could be a good company going forward, and they have a nice dividend payment that they will pay out, and so I've bought shares again. Again, my housing market view was perhaps in the past a bit too short term. I felt that houses couldn't sustainably increase, but why bet against it when you can invest in it as well? And in that way, I feel that you may as well just stay invested over the period of the time, and if you're going to be holding for the long term anyway, it doesn't matter what the house prices do in the short to medium term. And I think that's something that has changed since I had sold out of this share. I do remember them removing themselves from London and working more into less perhaps densely populated areas, or going to other cities for growth in their new builds. I think that's a very clever idea. I think people will be moving away from London in the future, and I think that trend will be there, and I think that actually we'll be seeing a lot more perhaps remote working in that regard, and I think they can do well in the future. I don't hold too many shares, and in fact I can't even say I remember how many I hold, but I think I hold 10 shares of Redrow. Nothing amazing by any means, but again, it's there, and they have a low dividend payout ratio of 33%, so they could be quite a good little earner in my SIP portfolio. As I said before, overall I'm down 7.51% for the week, and it is what it is. I will continue investing the same way I do. I'm going to look to maximize my earned income. At the moment, I've noticed a critical error in my strategy in that I don't understand the financial statements as well as I thought I did. So now I'm diving in deeper to learn about this. And I think once I've got my core holdings, which I've got Boohoo, I've got Games Workshop, I may be adding Dunelm to the ISA portfolio. Then I'm going to be looking to perhaps refine down on my financial analysis and then really look elsewhere. My growth will be in my earned income. That's really where I can do the most. A lot of people are going, you're down 36.06% in 348 days. You should be looking at your portfolio percentage for performance. It's the most important factor. In reality, it really isn't. The most important factor is how much you're able to save and invest into the markets, because when you only have a limited amount of capital invested, the best thing you can do is increase the amount of money or the equity you have in the stock market. That is by far the most important thing that new people in the markets need to achieve. And I feel that that's exactly what I'm doing. I'm looking to earn more. I'm not going to spend my time doing technical analysis at the moment because I feel it's not worth my time. I'd rather invest in the stock market, leave it, because in 15 years time it doesn't matter what pence of a share I got the price at, and instead I can invest that time where I would be spending looking at the charts and trying to do technical analysis in looking in how to make more money, how to perhaps progress up the chain with my employer, or how to make more income through my YouTube channel. So that is my strategy, and I've wrapped it up for you like that. As I've said before, card at the top right of the video if you want to see my analysis of Games Workshop's trading update. Aside from that, have a fantastic week.